Hello and welcome to another episode of ET Market Smart Talk. Well, I'm your host Kshitij Anand, and today we are decoding one of the most important developments for debt market participants. The latest RBI policy and what it means for fixed income investors heading to 2026. Now, joining us is someone who needs no introduction in the world of fixed income, Puneet Pal, who's head of fixed income at PGIM India Mutual Fund. Puneet, great to have you with us on the show.
Thank you. Thank you, Shailesh.
Thank you so much for taking the time out, Puneet. And you described RBI's policy as dovish. So, what specific elements make it so?
Yes, in our view, it was a dovish policy or a dovish rate cut. And why we think it was dovish is because RBI, I think they have been reducing the inflation forecast for this financial year, but they also reduced the forecast for the first half of the next financial year, which is FY27, from 4.5 to 4%. Apart from the rate cut and this lower inflation forecast for next first half of the next financial year, they also announced OMOs of 1 lakh crore plus a liquidity infusing measure of USD INR swap of 3 years for another $5 billion. So totally infusing liquidity of almost 1.45 trillion INR for this current month of December, and promise to do more if required. And also the fact that they were not very, I will say, skeptical about cutting rates further. They said that it will be open to data, incoming data. And RBI governor in his press conference also mentioned that going forward, the growth can somewhat slow down. So all in all, if we look at in entirety, I think it was a dovish cut, and that's why we put or will describe it as a dovish policy.
Absolutely. Now, we'll definitely discuss all the elements that you mentioned in detail as we progress in the discussion. But the RBI announced about 25 basis point rate cut and a 1 trillion rupee of OMO purchases. How unusual is this combination, and what message is the central bank sending to the participants?
So I'll not say it's an unusual combination because RBI has done this earlier also. In fact, earlier during the year, RBI has done OMOs
Hmm.
along with rate cuts, though they have not expressly announced such a big quantum at one go. I mean, we have seen them doing OMOs right from January of this year, which is the start of 2025, till May. And they have done rate cuts also during the same time frame. So I will not say it's unusual.
Hmm.
When it comes at this juncture, when actually rupee was under some pressure, we have seen the rupee hitting an all-time low against the US dollar, and there was some talk that to protect the rupee slide, probably RBI can be a bit more conservative, and especially given the strong growth that we saw in Q2, which got released just a week before the RBI policy. So overall, this backdrop of a weaker currency and strong growth was making some analysts comment that RBI probably will be more conservative, but I think they stuck to their prime objective, which is inflation,
Okay.
and they're governed by the inflation targeting framework. So I think they went ahead, and it was quite clear that inflation is consistently below the medium-term target of 4%. Then they will be cutting rates, and they will be providing liquidity in the markets. And given also the backdrop that your durable liquidity in the banking system has come down over the last 6 months. Currently, the durable liquidity stands around 3.6 lakh crores. It was, I mean, if you go back to the month of June, it was well over 5 lakh crores.
Right.
So all in all, I think the message that they gave was that they will stick to the inflation targeting framework. The entire MPC operations are governed by the inflation targeting framework, and they will provide both monetary accommodation in the form of lower rates as well as high liquidity as and when required. But it was not
Completely.
only, they have done it earlier also.
Absolutely. But yeah, I think the only thing was the quantum was bit high as compared to others. But for the benefit of our listeners as well as the viewers, can you explain in simple term what an OMO purchase is and how it sort of directly impacts liquidity and bond yields?
So OMO purchases basically means that the RBI buys bonds from the secondary market, basically buying bond from the market participants and giving them cash in return, just like a secondary market transaction that I buy a bond from somebody else in the market and gives them cash. RBI does it to infuse liquidity in the banking system because banks who are holding excess bonds on their books can sell it and get back, or get cash in lieu of those bonds. So that's a basic transaction, and it is not unique to India. Worldwide, central banks employ this tool of OMOs.
Right.
We have seen ECB doing it. The Fed was the first one, actually, to do it on a very large scale in the 2008 crisis, in the aftermath of the 2008 crisis, when they started buying government bonds, which are known as treasuries in the US. They also bought non-government bonds.
Yes.
In India, so far, we have seen RBI buying only central government and state government bonds. But worldwide, we have seen this phenomena of the central bank buying bonds from the secondary market to infuse liquidity in the markets. And at a very fundamental level, it means buying bonds by the central bank and giving cash in lieu of that.
Absolutely. And RBI also announced a 3-year USD INR buy sell swap of $5 billion. What purpose does this tool serve, and how does it sort of help manage liquidity in the system?
So basically, they'll buy dollars and infuse liquidity in the spot. They buy dollars in the spot market and infuse liquidity in the spot market, or rupee liquidity. So they will infuse rupee liquidity and by selling dollars. So once they sell once they buy dollars, so this is a buy sell swap. So they buy dollars and they sell, or they give out rupee liquidity in the market. So it is again a tool of liquidity infusion. So basically, what any central bank or RBI for that matter does is that they're expanding their balance sheet. So they'll buy bonds, give rupee liquidity in return. Then they will buy dollars and give rupee liquidity in return. So basically, it is a method or a tool of providing liquidity in the markets. In a buy sell swap, what happens that they will reverse this transaction after 3 years. So the contra entry will happen after 3 years, but in the immediate term, they will just buy dollars from the market and give rupee liquidity to the market participants. They have again done this earlier also, so it's nothing new for the market participants. The reason is primarily to infuse rupee liquidity, and maybe to some extent, I think, lower the forward premium also, but primarily to give rupee liquidity to the market participants.
Absolutely. And you did mention that while this may be the last rate cut of the cycle, bond yields will still find support. So, what are the key drivers behind this view, Puneet, if you can help us?
Sure. Yes. So first of all, we do believe that this probably was the last rate cut in this rate cutting cycle, simply because of the fact that your inflation, probably we have seen the bottom. Going forward, it will rise. RBI has also projected, though they have lowered the projection from 4.5 to 4% for the first half of FY27. But even if it remains at 4%, we don't see the rates coming down more than that. More than the current levels of repo rate at 5/4. Only if inflation undershoots 4% by a considerable margin, then probably RBI has some more space to reduce rates. But at this juncture, we believe that given the 4% target and the expectations of 4% inflation remaining in FY27, we don't see any incremental rate cuts from here on. On second part of your question, and if you can just repeat, I'll.
Key drivers behind this view.
Yes. So support of bond yields are coming in the form of RBI purchases of bonds. OMOs are one such tool. So 1 lakh crore is what they have promised this month. What they are going to do this month, already 50,000 crores have been done yesterday. So going ahead, they can do more. This will provide some support to the markets, because currently the bond markets are having a supply overhang. There is an adverse demand supply dynamics playing out in the bond markets. And also the fact that there is a higher probability of Indian government bonds or FAR government bonds specifically getting included in the Bloomberg Global Aggregate Bond Index.
Right.
So those flows can also provide support to the bond market. So that's why we said that, in our view, this being the last rate cut, OMOs, the inclusion, probable inclusion in the Bloomberg Bond Index, and I think worldwide, the US Fed has also cut rates. So all those factors can support the bond yields.
Absolutely. And lastly, for retail and HNI investors listening, to the podcast, how should they position their fixed income portfolios in the new policy environment in, let's say, the year 26?
Yeah, I think first of all is that any individual investor has to take into account his risk appetite and his investment horizon. These are the two cornerstones of any investment decision that they might be taking.
Sure.
I mean, they have to first of all, see what kind of risk they are comfortable taking, and secondly, what is the investment horizon. So keeping that in mind, they should invest. And in from a bond market perspective, I will say that given that the our view is that rates have probably bottomed out at these levels.
Mm.
Policy rates I'm talking about. One can look at corporate bond funds, which are giving you a decent approval,
Mm.
and with no rate hike in sight. So while our view is that there won't be any further rate cuts, but we also don't think there will be any rate hike. So it will be a period of prolonged pause on policy rates by RBI. Maybe over the next 1 year, we'll see unchanged in terms of policy rates. So accrual becomes important in the overall return for fixed income instruments. So we will suggest corporate bond funds to investors. But again, the investor has to keep in mind his risk appetite and the investment horizon.
Absolutely. Wonderful insights, Puneet, as always. The policy may have been surprised the market, but conversations like this help investors understand the deeper implication. Thank you so much for your time, Puneet.
Thank you. Thank you, Shitish, for having me here. Thank you very much.
Thank you so much.